So today, we're going to pull back the curtain on something called the Sharpe ratio. Now, it might sound a little complex, but it's actually a surprisingly simple number, and it is, without a doubt, the #1 tool used by the quants on Wall Street. Let's dive in, because once you get this one number, you unlock the biggest ideas in modern finance: diversification, leverage, and what risk really means.
All right, to kick things off, let's start with a little puzzle. Here we've got two investments, green and black. Now, at the end of the year, they both land in the exact same spot, a 40% return. So the question is, which one is better? I mean, on the surface, they look equal, right? But I bet you already have a gut feeling about which one you'd rather have your money in.
So how do we answer that question? Well, we can't just look at that final 40% number. See, this is the big problem with only looking at returns. The real secret is in the path each investment took to get there. The green line, it's a nice, smooth, steady climb. The black line, well, it's kind of all over the place. To figure out which one is truly better, we have to understand why those wiggles matter so much.
So why are these wiggles so bad anyway? Our intuition tells us they are, but let's break it down. First off, there's the psychological pain. It's just a fact of human nature that losses hurt way more than gains feel good. Riding out that huge dip in the black line would be incredibly stressful. Second, it just gives you less confidence. That chaotic path makes you wonder, is this skill or just pure luck? And third, there's liquidity risk. Imagine you suddenly needed cash right at the bottom of that big dip. You'd be forced to sell at a massive loss.
So here's the absolute key takeaway. Those wiggles are just a picture of risk. And that lets us solve our first puzzle right now. The black investment is worse than the green one because it took on way more risk to get the exact same 40% return. And just looking at that final percentage, it totally misses this critical piece of the story.
All right, so that brings us to the next big question. If risk is the problem, we need a way to measure it, right? We can't just call it wiggly or bumpy. We need to put a real number on it. We need to quantify the wiggles. And the simplest, most common way we do that is with a metric called volatility, often shown by the Greek letter sigma. Now, don't let the name freak you out. All it is the standard deviation of an investment's returns. Think of it this way. It's just a number that tells you the average size of those wiggles, how far the price tends to wander away from its main path. The bigger the wiggles, the higher the volatility. Simple as that.
Okay, so now we've got a number for our return, and we've got a number for our risk. And this is where the genius of the Sharpe ratio comes in. It takes both of those ideas and combines them into one single beautiful number that tells you the whole story in a single glance.
Here's the formula, and I promise it's way more intuitive than it looks. On top, in the numerator, you have your average daily return. That's the good stuff, what you're earning. And on the bottom, in the denominator, you have volatility. That's the risk, the bad stuff. So you're literally just dividing the good by the bad. A higher return makes your score go up, and higher risk penalizes it. Oh, and that last part, multiplying by the square root of 252, that's just a little trick to turn the daily score into a yearly number, since there are about 252 trading days in a year. It just lets us compare everything fairly.
So let's go back to our original puzzle and see what happens. Remember our steady green investment? It gets a Sharpe ratio of 2.0. And the wild, wiggly black investment, it gets a measly 0.5. This just perfectly captures what our gut was telling us all along. Green is a whopping 4 times better than black because it delivered so much more return for every single unit of risk it took on.
But what do these numbers actually mean in the real world? Is 2.0 good? Well, to give you some perspective, the S&P 500 historically has a Sharpe ratio of around 0.45. The legendary Warren Buffett, his is about 0.75, but the top-tier hedge funds, the absolute best of the best, they are hunting for strategies that have a Sharpe ratio of 2.0 or even higher. That's the gold standard.
Now, looking at one investment is cool, but the real magic of the Sharpe ratio, where it truly shines, is when you start using it to build a portfolio of multiple things. This is where things get really powerful.
So let's try another puzzle. We have two new investments, red and blue. And this time, they look identical on paper. I mean, exactly the same. Same return, same volatility. And because of that, they have the exact same Sharpe ratio of 2.0.
So, what do? If they are statistically identical in every way that matters, is choosing between them just a coin flip? It really seems like there's no right answer here. But is there?
Well, the secret, once again, is hiding in the wiggles. If we look closely at how they move over time, we see something incredible. When red zigs up, blue zags down. When red goes down, blue goes up. Their wiggles move in opposite directions. In the world of finance, we call this being negatively correlated.
Okay, so what happens when we put them together? If we create a simple 50-50 portfolio, let's call it the purple portfolio, something amazing happens. Because their wiggles move in opposite directions, they basically cancel each other out. The total return of the portfolio stays the same, but the overall risk, the wiggles, absolutely plummets. And the result? You get a jaw-dropping Sharpe ratio of 5.0. This is the fundamental idea of diversification, and thinking in Sharpe ratios makes this powerful concept crystal clear.
Okay, I know what some of you might be thinking. This is all great, but what if I find an investment that has a lower Sharpe, but just makes more money in the end? Isn't a higher return just better? And you know what? That's a totally fair question. To answer it, we have to talk about finance's secret weapon, leverage.
Yeah, let's just be direct about it. What if a high-return strategy just ends up with a bigger pile of cash than a high Sharpe strategy? After all, you can't eat Sharpe ratios, right? You spend dollars. Doesn't that make the whole thing kind of pointless? Well, the answer is a surprising no, and leverage is the reason why.
So what is leverage? It's just borrowing money to invest more than you actually have. Let's say you've got $100. You go to a broker, you borrow another 100, and you invest the full 200. That's 2x leverage. Now, if your investment goes up 1%, you just made $2. On your original $100, that's a 2% return. Your gains are amplified. Of course, the scary part is, so are your losses. But here is the absolute key, the most important thing to understand about leverage. It amplifies your returns, yes, but it also amplifies your volatility by the exact same amount. So if you use 2x leverage to double your returns, guess what? You also double your risk. And since the Sharpe ratio is just returns divided by risk, if you double the number on top and you double the number on the bottom, the ratio itself doesn't change one bit. It stays exactly the same.
And this is the final amazing insight that ties it all together. It means you can take that smooth, beautiful, high Sharpe strategy and apply leverage to it. You can dial up the risk and the return to whatever level you want, which allows you to match or even beat the final dollar return of that other riskier strategy. You get the best of both worlds, the high returns you're chasing, but with a fundamentally superior, smoother engine running underneath.
So let's put it all together. What's the new mindset here? First, just looking at returns isn't enough. You have to account for the risk, the wiggles. Second, the Sharpe ratio is the best tool we have for measuring that risk-adjusted performance. Third, it's the key that unlocks the true power of diversification. And finally, leverage is what turns a high Sharpe strategy into an absolute powerhouse. Your goal as a sophisticated investor is to find and build portfolios with a Sharpe ratio of 2 or more.
And that's pretty much it. You now understand the single most important number that professional quantitative traders use every single day to make decisions. So I'll just leave you with this one question to think about. Now that you have the #1 metric quants use, how are you going to evaluate your next investment?